All right, so you're a commercial banker, but what does that really mean? It's not just about crunching numbers on a spreadsheet. No, your real job is to be a financial detective, to uncover the real story a business's financials are trying to tell. What are the risks, and can they truly repay their debts? Today, we're going to walk through that lender's journey.
So let's just jump right in with a big one. A company reports a massive profit. That must mean they're flush with cash and can easily pay their bills, right?
Nope. Absolutely, fundamentally wrong. And listen, this is one of the most critical concepts in all of lending. Profit is just an accounting opinion. Cash, on the other hand, is a fact. And as lenders, we deal in facts.
So your mission, really, is to look right past that reported profit and find the true story. And to do that, you need a process. You need a healthy dose of skepticism. And you need to understand how all the pieces, the balance sheet, the income statement, and the cash flow statement fit together to show you the truth.
Okay, let's get into the framework. Step 1 is all about developing expectations. You see, the best financial analysis doesn't start with the numbers you're given. It actually starts with the numbers you expect to see before you even look at a single spreadsheet.
So before you open that file, you got to ask yourself, what is this business? Is it a manufacturer making widgets? A retailer selling clothes? A tech company providing a service? Because the answer to that question gives you a blueprint, a kind of financial fingerprint for what it should look like.
And just look at the difference here. A retailer, for instance, has most of its assets, we're talking 50, even 60%, tied up in inventory sitting on shelves. And they have very low accounts receivable because you and I pay with a credit card right at the counter. But a manufacturer, totally different world. They've poured a ton of money into fixed assets like factories and equipment, and they have huge receivables because they give their business customers time to pay. Understanding this baseline is what helps you spot a red flag from a mile away.
And that leads us perfectly into step 2, scrutinize the statements. This is where we take those expectations we just formed and compare them to the reality of the financials. We're looking for anything that seems off. And more importantly, we're asking why it's off.
Now, a huge part of the scrutiny is being aware of something called accounting risk. You have to remember it. The company itself prepares these statements. And even though they have to follow the rules, there's a surprising amount of wiggle room they can use to paint a much rosier picture than what's really happening.
Take revenue recognition, for example. The time of sale method is pretty clean. You deliver the goods, you book the sale. Simple. But the percentage of completion method? That's based on estimates. Construction company could say a project is 80% complete just to book that revenue today, even if the cash won't show up for months, if it shows up at all. Your job is to question those estimates. It's the same story with how they value inventory. Let's say prices are going up. If a company uses the FIFO method, first in, first out, they get to match their old cheap inventory costs against their new higher sales prices, and boom, instant profit boost. It's totally legal, but that profit is artificial. It's not sustainable. You have to understand which accounting choices they're making and why.
Now, these accounting choices directly impact the numbers we use for our analysis, and that analysis often uses tools called ratios. But please, don't get lost in the formulas. The trick is to group them by the big, fundamental question they're trying to answer. So, let's start with liquidity ratios.
These ratios are all about one simple, crucial question. Can this company pay its bills right now? Does it have enough cash or assets that are about to become cash to cover all of its upcoming payments? That's it. That's the whole game.
Okay, let's move on to the next major group, capital structure ratios. This is all about how the company is financed. Where did the money come from to buy all its assets? Did it come from the owner's pockets, or did it come from lenders like us?
And the question this really answers is, who has more skin in the game? Is the company running on a ton of debt, or is it mostly financed by the owner's own money? This tells you exactly who stands to lose the most if things go sideways, and it's a direct measure of the risk the bank is taking. Which brings us to our third and final step. And honestly, this is the most important one of all. Follow the cash. Because at the end of the day, loans are repaid with cash, not with accounting profits. I want you to remember this quote. It's a core principle of good lending. Collateral, that building or inventory we could seize, that's just a fallback plan.
It is no substitute for a company's ability to generate cold, hard cash from its operations to make its loan payments.
So how do we find the real cash flow? Well, we build a bridge. We start with that net income number they reported. First, we add back any expenses where no cash actually left the company, and the big one here is depreciation. Next, we have to adjust for real cash movements. For example, if accounts receivable went up, it means they made sales but haven't collected the cash yet, so we have to subtract that amount. If their accounts payable went up, it means they've held on to cash instead of paying their suppliers, so we add that back. This process strips away all the accounting layers to show you what cash the business truly generated.
And what drives this cash flow? It really boils down to just three main levers that management can pull. First, sales growth. How fast are they growing? Second, profit margins. How much do they actually keep from each sale? And third, asset turnover. How efficiently are they using their stuff, their inventory, their machines to generate those sales? Your analysis has to focus on these three drivers.
So we've gone on the journey. We've developed our expectations, we've scrutinized the statements, looking for risks and checking the ratios, and we followed the cash right to its source. Now we just have to bring it all together.
This simple three-step framework is your guide. It's your roadmap. It takes you from a high-level understanding of an entire industry right down to a deep, cash-focused analysis of one specific business. It's a repeatable process you can use on every single credit that comes across your desk.
But after all the ratios are calculated, after the cash flow models are built, after all the spreadsheets, what's the one single question that ties it all together? What's that final check that tells you whether you've truly understood the business?
And this is it. Does the story the numbers tell match the story management is telling you? If management says they're all about efficiency, but you can see their inventory is turning slower and slower, the stories don't match. If they're bragging about huge profits, but their cash flow from operations is negative, the stories don't match. When the numbers and the narrative are in sync, you have clarity. And when they're not, well, you've just found your next set of questions, and that is the art and science of being a great commercial banker.